Here to dive into industry trends with leading ETF experts, this is ETF Spotlight with Nina Mishra.
Hello and welcome to ETF Spotlight. I'm your host, Nina Mishra. My guest today is Dr. Derek Horstmeyer, professor at George Mason University School of Business, and he's a regular contributor to the Wall Street Journal. His research focus areas include ETF and mutual fund performance. So we like to catch up with him from time to time, and these conversations are always a lot of fun. So Dr. Horstmeyer, welcome back. Great to have you with us today.
Thank you again, Nina, for having me on today.
So I was looking at your articles, and you have published so many interesting research pieces in the past few months. But let's start with dollar cost averaging, your latest piece, which was published in the Wall Street Journal, because lately we have heard from so many pundits on CNBC and Bloomberg that stocks have become attractive after the recent sell-offs, but it's better to use dollar cost averaging. So tell our listeners what dollar cost averaging is, and does it work?
Sure, yeah, happy to. Yeah, so that was a fun piece we did about a month ago, and we compared a dollar cost averaging strategy to a fixed share buying strategy. So a dollar cost averaging strategy is kind of what most people use, and it's basically if you have $100 of disposable income, you consistently put that $100 into the market every month. And so if markets are going up, you're buying less of a company. If markets are going down, you're buying more of a company, more shares in a company. We compared that to a fixed share buying strategy where you're buying a fixed percent of the firm over every month or so. And we found some interesting results. We found in general a dollar cost averaging strategy works a little bit better to the tune of about 0.4% per year in better long run returns. So that can really add up. It's 40 basis points in extra returns, and works very well in up markets, not quite as well in down markets, and does pretty well over both high and low volatility regimes. So pretty good method of getting your money into a market. Again, it would add about 40 basis points in returns per year.
Right. It's a good strategy, and particularly in volatile markets like we are in currently, because it can reduce emotional decision making. And we know that it's always better for investors to focus on the long term and not try to time the market. So just put a little bit of money, that amount, whatever you want to put, at regular intervals, and probably in low-cost S&P 500 tracking ETF like VOO or IVV or SPLG, and you'll be good over the long term. And another option is when there's a lot of economic uncertainty, economic policy uncertainty, you can try to avoid stocks. And we are not talking about selling your stocks. We are talking about, extra cash on that you have on the sidelines. Maybe keep it till there's better clarity on economic policy. So you had published this timely piece that was also in the journal at the start of the year about the uncertainty surrounding economic policy with the beginning of a new administration and why it's better to avoid stocks at that time. So tell us about this research.
Yes, of course. Yeah, that was another fun study that we did where we looked at a measure of economic and policy uncertainty. And I don't think it would surprise anyone, but we found that when policy uncertainty is increasing or is very high, your riskier areas of the market are not doing well. So we looked at big jumps in policy uncertainty, and across the board, you see just massive valuation when uncertainty increases. And so you can kind of time it, obviously, going back to the beginning of 2025, when there was a huge amount of tariff uncertainty and policy uncertainty there. We saw, in January and February, we saw, large cap, U.S. growth, value, et cetera, all falling by a few percentage points.
Right. So now we don't know whether we are almost at the end of this uncertainty, and we don't know whether next week we'll hopefully learn a little bit about the extent of tariffs. But if investors had followed your advice at the beginning of the year, they would have done quite well, because S&P 500 is down almost 5% or more than 5% year to date now. And you also looked at the small cap performance in this. The Russell 2000 index of small cap stocks is down about 10% now year to date. So let's hope this uncertainty clears up and we get better clarity on the tariff policy next week.
Exactly. Yeah. And I wouldn't be surprised if we get a lot of clarity on uncertainty. What we see in the data, when uncertainty resolves itself, again, not surprisingly, the results go the other direction and equities gain a lot of value. So if we get a lot of clarity of policy coming up in the next month, we'll probably see small caps pop and international stocks pop, emerging markets will go up. Yeah, most likely.
All the riskier high beta areas of the market will do well if there's better policy certainty.
Exactly.
Better policy clarity next week. Let's hope for that. So many investors rely on valuation metrics for making their stock market purchases. And one interesting piece that I saw was your article about PEG ratios, whether it's a reliable market timing tool. So could you explain to our listeners what PEG ratio is and what did you learn from that study?
Yeah, of course. So I think investors are very familiar with PE ratio, which is your price over earnings ratio. Right now, on a forward-looking basis, I think we're somewhere around 22 for the forward-looking PE ratio. And that's one way we can value stocks. But another way we can go even further, and some people like to take your PE ratio and divide by the future growth rate of earnings. So you can imagine if you have a PE ratio of 22 like we have now, and growth rate in earnings is also 22% per year, that would get you a PEG ratio of 1, because 22 divided by 22 gets you to 1. And what we see is, in general, the PEG ratio is right around, it kind of hovers between 1 and 1.5 for most of time, and oscillates quite a bit. It went up a little bit recently, but it kind of stays between 1 and 1.5. And we started to look at, is there any value in kind of buying when the PEG ratio is low and selling when the PEG ratio is high? And it wouldn't surprise our efficient market folks to learn, it doesn't provide that much value. You're kind of just as good, not following it as you are following it. Our hypothesis was that when the PEG ratio is high, markets are overvalued, and so you should get out of equities. And when the PEG ratio is low, that's when the market's undervalued and you should get in. But we didn't find that result. Not on a statistical significant level.
Very interesting. And just out of interest, I looked at the PEG ratio, some of the most popular stocks this morning. And it was interesting that NVIDIA among the MEC 7 currently has the lowest PEG ratio. It is according to Zacks.com. You can screen for PEG ratios on Zacks.com. And NVIDIA currently has a PEG ratio of 0.9. 0.99. That I thought was pretty interesting because, of course, growth expectations are so high for this particular company, and the stock has sold off in the past few weeks. And again, this is not an investment advice. We don't give investment advice on this podcast, but I thought it was interesting. And Meta currently has a PEG ratio of 1.28, Amazon 1.39. The most expensive stock among the MEG 7, according to the PEG ratios, is Tesla with a PEG ratio of 4.14. Now let's talk about sentiment metrics and whether they matter to the markets, because we are hearing so much about consumer sentiment data being so weak, the soft data being so weak lately in the past few weeks. This morning, we got University of Michigan Consumer Sentiment Index, which tumbled to more than 2-year low. And earlier this week, we got the Conference Board's Consumer Confidence Index, which tumbled to its lowest level in 4 years. And we have also heard from CEOs of so many consumer-facing companies. They are warning about a cautious consumer. Lululemon is the latest one this morning. Their stock is plunging, and that comes after similar warnings from CEOs of Target, Best Buy, Nike. And experts worry that if consumers become increasingly pessimistic about the economy, they may start cutting back on spending, and that could potentially trigger an economic downturn, because we know that consumer spending accounts for almost 70% of the GDP. But so far, labor market and other economic reports have not indicated any signs of a slowdown. So tell us about your study on the sentiment metrics.
Yes, of course. Yeah. So in that work for the CFA Institute, we looked at how does consumer sentiment over the time periods, over the ages, really correlate with returns. And if we go back to the 70s and 80s, there was a high correlation between returns and consumer sentiment. So when consumer sentiment was high or increasing, we saw that riskier stocks did well. But since then, it's kind of decreased. It's decreased over time, and actually went negative in the 2020s, which is an interesting result. 2020 to 2024, we actually saw the markets doing very, very well when consumer sentiment was low. And it obviously reversed recently in 2025, but there was a 4-year period where there was no relation, and actually a negative relation, between consumer sentiment and market returns. And there could be a lot of reasons for this. A lot of the reasons why markets have been going up over the past 4 years has been related to AI and other new innovative technologies. So that could be one reason.
Yeah, I agree with you. There's several reasons why many consumers are still spending. And we know that it's been a tale of two consumers here in the US. So lower income consumers have become more pessimistic because inflation has remained persistent, particularly for household staples like eggs. And on the other hand, the top 10% of households, the richer consumers, wealthier consumers. So I saw an article in the Wall Street Journal that those earning more than $250,000 annually, they continue to spend on everything from luxury goods to vacations, and they now account for almost 50% of total consumer spending, and that is according to a Moody's report. And we know that wealthier consumers, rich people, their net worth has surged in recent years. You mentioned AI, and stock market has gone up a lot. So these consumers have seen massive gains in their stocks and real estate portfolios. So unless probably there's an epic crash in stocks, probably these consumers will continue to spend, right?
Yeah, I think you're right. I think it really is a tale of two different, sets of consumers. And you're right. It really is the upper income individuals that have been doing, very well since COVID, right? Issues like work from home and white collar positions did fine over 2020 to 2024. And for that reason, stocks have gone up, 50% over the past 4 to 5 years.
Right. And for consumers, for investors who are worried about a recession, they can look at safe haven assets like gold or other commodities, or they can look at money market funds. And money market funds have been quite interesting. So assets in money market funds, they surpassed $7 trillion recently because these are almost risk-free and investors get attractive short-term yields close to 4.3% right now. You did a study on money market funds, and I was interested in your analysis how investors can choose the best money market funds, which are so popular now.
Yeah, we did another fun study. I've always taken it for granted that you could find when the T-bill rate or when the Fed increases rates up to 5%. I always thought that all money market accounts would go up to 5%. But we were surprised to find, no, that's not really the case. We found a lot of money market accounts, even when interest rates were at 5%, or when the Fed had raised rates to 5%, the money market account was still paying 1%. And so we were shocked to find that some very big spreads in what you could get. Now, a lot of these were hidden in, kind of money market accounts that might be sitting in really bad 401ks or other just bad products. But yeah, a lot of people might be still getting 1% on a money market account out there. And to the tune of, about 20% of money markets were still paying just 1%.
Wow. That's shocking.
Yeah.
And for investors who love ETFs, who prefer ETFs, now there are 3 money market ETFs available, and they are ultra low costs. They charge us 20 basis points. So those are great options. And the ticker symbols are MMKT, PMMF, and GMMF. I'll talk a little bit more about these money market ETFs in a bit. And I mentioned the other option is gold and other commodities, because they also provide a hedge against recessions. And you took a look at many commodities, whether they do provide a hedge against recession or not. Please tell us about your finding.
Sure. Yeah. In that piece, we went back and we looked at kind of recessions through the ages, going back 60 odd years, looking at different levels of recessions. And the one thing that really stood out was, commodities did okay. They still went down in value in general during recessions. But gold was the one that stored its value and actually went up in value over most recessions. So gold was the best commodity. If you're convinced we're going into a recession, then gold has a pretty good track record there. On the other end, oil, that wouldn't surprise most people, oil well in recessions. And obviously there's a demand story there. When we go into recession, global trade goes down, consumption goes down, and so therefore oil goes down.
Interesting. And I totally agree. Gold is the best safe haven asset and the best hedge. If you're worried about a recession, and gold has been doing so well lately, so it is now close to an all-time high. And also, I like gold because of its diversification benefits. I think it deserves a small allocation in a portfolio, and there are some great gold, ultra low cost gold ETFs which investors can consider, like GLDM or IAUM. And talking about a little bit more about diversification, we know that market gains over the past few years have been driven mainly by technology giants, the Magnificent Seven, or whatever you want to call them. And because of that, the major indexes like the S&P 500, they are not as diverse as they used to be. They are dominated by these tech giants. They're very top heavy. Tell us about your research and why that matters.
Of course, yeah. I don't think it would surprise anyone to really note that the S&P is just become, as you say, very top heavy, right? You have 7 companies in the S&P which are making up 25% of it, or even more. So it's become a very top heavy index. So we went back and kind of tracked things over time, and we went back to the 1970s. And again, the way the S&P has changed has become much more financial companies and much more tech companies. And counter to that, we've seen industrial and material companies kind of fall off. And that's just kind of the changing nature of, production here in the US, right? We used to have a lot more industrial companies, and now we have a lot more tech companies. Another really interesting finding we looked at when we looked at that study with the S&P is the S&P now correlates a lot with the rest of the world. So we looked at how the S&P moves with international indices, and the S&P moves almost with a correlation coefficient of 0.75 with the rest of the world. So what that kind of highlights is getting world diversification is more difficult now, or getting a reduction in risk is more difficult now. It used to be easier to add other markets to your holdings and get a reduction in risk. And now, because the correlation coefficient is so high, reducing equity risk by going outside the US doesn't help much. So that was another interesting finding we found.
So what do you think investors should do?
That's a very good question. I don't quite have an answer for that. I think we're just letting investors know, the tech is so big right now. By investing in the S&P 500, you are really exposed to tech risk. And if you want a reduction in risk out there, you're going to have to go look at, unique, maybe hedge fund like products or other uncorrelated assets out there, which are becoming harder and harder to find.
Okay, so let's hope that tech will be back and we get better clarity on tariff front and trade wars, etc. But staying a little bit more on the top heaviness and this group of the so-called Max 7 stocks, we know the trend Max 7 was so hot in the last couple of years, but these stocks are no longer so magnificent. They are not doing well lately. And you had an interesting piece that was also in the journal about these named trends and market returns. Tell us about that study.
Yeah, again, that was a fun one. We went back in time and tried to find all of these past trends that have been named by the press. And so some ones that your readers may remember from way back in the day, there was a trade called BAT. There was a trend called Cloud. Everyone's going to remember FANG. There was even a trend called granola from way back in the day.
What was granola?
Granola was, I want to get this exactly right. Granola was the companies GSK, Roche, Nestle, L'Oreal, LVMH, Novartis, Novo Nordisk, ASML, SAP, and Sanofi.
So those
So
are all European
big
companies?
European companies. So I guess
Mhm.
this was a trend that was named about 10 years ago.
Okay,
And
interesting.
so yeah, there was some interesting name trends out there, and we kind of aggregated them all together. And then we asked the question, well, is it once the trend has been named by the press, should you buy into it? And in general, well, it wouldn't surprise your readers. No, if once it's been named, you've kind of already missed the run up. So in the 2 years prior to it being named, you could get about 40% excess returns. So meaning before it's named, it goes up 40%. But then after it's named, it's basically flat. It goes up a little bit, but really not worth the risk. So once it's named, you've kind of already missed the train.
Very interesting. So probably Max 7 trend is over now. Okay, we'll have to leave it there. But thank you so much for joining us today. Really enjoyed the conversation.
Thank you, Nina, for having me. Always enjoy it.
That was Dr. Derek Horstmeyer. Now let's quickly recap the ETF tickers that I mentioned. If you want to invest in an S&P 500 tracking ETF, your best options are the Vanguard S&P 500 ETF, ticker symbol VOO, which is now the largest ETF in the world. Earlier this year, it dethroned SPY as the SPY S&P 500 ETF. And another good option is IVV, which is by iShares. Both VOO and IVV charges 3 basis points. But the SPDR portfolio S&P 500 ETF with the ticker symbol of SPLG, that is even cheaper with an expense ratio of just 2 basis points. So these are ultra low cost ETFs for investing in the broader market. Now, talking about the money market funds, there are 3 ETFs available to investors now. 2 government money market ETFs. The first one is by Texas Capital, and the ticker symbol is MMKT. And the one by iShares is GMMF. Now, these government money market ETFs, they invest in treasury bills and agency bonds. And there is one prime money market ETF, which holds both corporate and government securities, and the ticker symbol is PMMF. Now, if you want to invest in gold, the ETFs that I love are the ultra low cost GLDM and IAUM. GLDM charges just 10 basis points and IAUM charges just 9 basis points. And GLD, which is very popular among traders because of its liquidity, that charges 40 basis points. Thanks for listening. If you like our show, please leave us a rating on iTunes or wherever you get your podcast. Make sure to subscribe so that you do not miss any episode. If you have any comments, questions, or suggestions, please email podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.